Bismillahirrahmanirrahim. Hi everyone, welcome back to the another video. Today in this video, we are going to discuss the leisure portion of retirement of a partner. In previous video, we have already discussed the general portion of that one. If you have not watched that video, then first of all you should watch that video. Then you will be able to understand this one. Okay, see here are three partners in the firm. Profit sharing ratio is given here 3:2:1. X, Y and Z are the three partners here. Their profit sharing ratio is 3:2:1. Y retires from the firm on 1st April 2018. Y is taking retirement from the business. On the date, their balance sheet is given also. Trade creditors, bills payable, expense owing, reserve fund, capital and cash in hand, cash at bank, debtors, stock, factory premises, machinery, loose tools, etc. What were the terms at the time of retirement? Goodwill of the firm was valued at 13,500. This is the firm's goodwill. And the adjustment in this respect was to be made in the continuing partners capital account without raising goodwill account. Okay. Expense owing to be brought down 3,750. Next, machinery and tools were to be valued at 10% less than their book value. Factory premises are to be revalued at 24,300. These were the terms and conditions for the retirement. Now what we have to do, we have to prepare the revaluation account, partners capital account and the balance sheet of the firm. First of all, we will do the revaluation work. Then after we will do the partners capital account. After that we will prepare the balance sheet. In revaluation account, as we know that increase or decrease in the value of assets or liabilities will be shown here. First of all, we have to find out that what types of assets are increasing or liabilities are increasing or decreasing. Expense owing to be brought down 3,750. What was the expense owing here? 4,500. How much is reducing here? Liability 3,750. It means 750 your liability is decreasing here. And if the liability will be decreased, then what entry you will pass? A liability account debit to revaluation account. So we will show here by expense owing. How much? 750. Next, machinery and loose tools are to be valued at the rate of 10% less than their book value. These are the assets and the value of assets is decreasing here. And if the value of asset will decrease, then what entry you will pass here? We will pass here revaluation account debit to asset account. So we will write here in the debit side to machinery account 10%, 8,000 of 10%, how much? 800. And to loose tools account 10% means 400. And at last, factory premises are to be revalued at 24,300. The value of factory was how much? 22,500. Now the new value is 24,300. How much the value is increasing here? 1,800 is increasing the value of factory premises. So we will write in the credit side by factory premises 1,800. Nothing is mentioned about the revaluation part, so we will close this one. Then 550. Here we will write also 2,550. Here 1,200, 1,200 is only. How much would be the profit here? 1,350 would be the profit here. We will transfer this one to profit on revaluation. X capital account, Y's capital account and Z's capital account. How much profit would be here? Profit sharing ratio is given 3:2:1. 1350 3 upon 6. 2 6 the 12, 2 7 the 14, 675 total value would be here. And the next partner 1350, 2 upon 6, 3 4 the 12, 3 5 the 15, 450, 450. And the last partner 1350, 1 by 6, 6 to the 12, and 6 to the 12, 6 5 the 30. These are the profits on revaluation. Now we have to prepare the partner's capital account. See here, first of all we will write the opening balance of capital by balance BD. What was the opening balance of their capital? 15,000 for each partners. Here is given 15,000, 15,000 and 15,000. We will write here 15,000, 15,000 and 15,000 for each partner. Now first of all we will transfer the profit on revaluation by a revaluation account. Profit 675, 450 and 225. Now we have to find out that if there is any reserve here. Reserve fund is given 13,500. This reserve fund will be credited to the partners capital account in old profit sharing ratio. Reserve fund account 13,500 is the reserve fund, and it will be distributed among the partners. 2 6 the 12, 2 7 the 14, 6,750 and 4,500 and 2,250. This will be the reserve fund. Now we have to make an adjustment entry for the goodwill. The firm's goodwill was valued at how much? 13,500. This is the firm's goodwill, 13,500. We have to find out the share of goodwill of the retiring partner. Who is retiring here? Y is retiring here, and the Y share is Y's goodwill. We have to calculate 13,500 divided by 2 upon 6. 2 3 the 6, 3 4 the 12, 3 5 the 15. 4,500 is the Y share of goodwill. Here in question nothing is mentioned about the retiring partner's profit share. So the new profit sharing ratio would be 3:1, and this new profit sharing ratio will also be the gaining ratio. So we have to make an entry which is gaining partner's capital account debit to retiring partner's capital account. Who will be the gaining partners here? X and Z will be the gaining partners and Y will be the retiring partner. So we will write here by X capital account by Z's capital account. How much? 4,500, and their gaining ratio is 3:1. It means 3/4. 1,375 would be the value of goodwill for X. So Y will get here 3,375 from X, and from Z 1,125. We will write here 1,125, and this amount of goodwill will be debited from X and Z to Y's capital account, from X 3375, and from Z 1125. Now we have to close this partner's capital account because all the things we have already provided. So here what will be the total balance? This is the total balance of all the partners. Now we have to make a balancing figure. For the retiring partner, nothing is mentioned about their payment. So all the amount of retiring partner will be transferred to their loan account. We will write here to Y's loan account 24,450. And now we have to create the balancing figure to balance CD. Now we have to prepare the balance sheet. In balance sheet, what we have to do? First of all, cash in hand, cash and bank, as it is, it will be cash in hand, cash at bank, debtors, and stock, factory premises, next machinery, loose tools. Now we have to write down the amount. Cash in hand 1500, 7500, 1500, 7500, and debtors 15,000, stock 12,000. Debtors 15,000, stock 12,000. Now factory premises has been increased, so we have to write down their actual value 24,300. Machinery has been decreased, so we have to minus this one also. 8,000 minus 800, it means 7,200. And loose tools 4,000 minus 400, it means 3,600. So these are the value of assets. Now on the liability side, what we have to do? Trade creditors, bills payable, as it is. Trade creditors, bills payable. Trade creditor is how much? 3,000. Bills payable 4,500. We will write here 3,000, here 4,500. Next, expense owing 4,500, but it has been decreased, so we will write the actual value. $3,750. Now reserve fund already provided. We have to write the actual capital. First of all, Y's loan account, how much? 24,450, and X capital account and Z capital. How much X capital was? 19,050, and Z capital 16,350. Now we have to balance this one. The total value would be here 71,100.